Finally, the time has come for some better news on housing and mortgages. Last week, the US inflation report for the month of October came in, and it might be a game changer. Yesterday, we received the Canadian Consumer Price Index report for the month of October, which also showed some easing price pressures. Still, we don't want to get ahead of ourselves over a single data point, but this does change the trajectory for how high interest rates are expected to go, but does not necessarily change how long high interest rates may remain at those elevated levels. Immediately, traders in the bond market in the United States lowered their expectations that interest rates would hover now below 5%, which is 50 basis points lower than prior to receiving the Consumer Price Index report for the month of October. We're going to discuss what this news means for Canadian homeowners and those who might be looking to get into the housing market, how they'll each be affected. Let's jump right into it. Before we do, you know the drill. Please hit that like and subscribe so you keep getting this content to help you navigate your real estate and investments. Before we jump into the nitty-gritty from the report, I want to help Canadian homeowners understand the impact of this low report on mortgage rates. If you hold a variable or adjustable rate mortgage, you can now breathe a small sigh of relief. There now appears to be a path for the Bank of Canada to taper interest rate hikes a little bit further in the months ahead. We'll undoubtedly see at least one more hike of 25 basis points at that December 7th meeting, but the priority is to see inflation show a consistent downtrend over many months before the Bank of Canada can justify a pause in interest rate hikes. Bond yields are falling pretty aggressively on the news. At the time of writing, they're down roughly 11 to 12% from their peak. Now, fixed interest rates are expected to fall in the coming days, but of course there are no guarantees the banks are going to pass on these lower yields because risk on mortgages is still very high. I'll provide updates on any changes to fixed rates on Instagram and Twitter, so if you want to follow those two accounts, they're going to be down in the description, so please go ahead and do that. Despite today's news, if you're still considering making the switch from a fixed mortgage to a variable rate mortgage, certainly nothing wrong with that, but I implore you to do it the right way. Don't visit your bank now and accept whatever 5-year fixed rate they're willing to give you. Instead, speak with an independent mortgage agent like myself and lock in a fixed rate for the next 120 days. If fixed interest rates continue to fall over the next 120 days, you'll be able to capture the lower rate that becomes available. If they don't, then you've already locked in the best rate that's available today. This decision can save you tens of thousands of dollars in additional interest expense, so don't be lazy to commit the time to coordinating some paperwork and getting that approval in hand. If you're a new home buyer or a step-up buyer, I strongly recommend going out right now and getting a 120-day pre-approval for a new fixed and variable rate mortgage. In the next few weeks and months, we're very likely to see the discount on variable rate mortgages shrink in a meaningful way. You should also get yourself approved for a fixed rate to guarantee yourself a maximum payment should you find a home within that window. But then you also need to observe fixed rates prior to your closing date because it's likely that we're going to see lower fixed rates over the next 120-day period. This next part is for anybody who's considering the purchase of a new home but is sitting and waiting patiently on the sidelines. I know it's tempting to wait for a perceived price bottom, but historically speaking, that can be a fool's errand. When it comes to investing, it's often better to get into the market a month too early rather than a month too late. I believe that to be even more true when discussing real estate. Today, you can use a mortgage agent to secure yourself a pre-approval for 120 days on a variable or fixed rate mortgage. That'll confirm the budget that you can purchase with and a payment that you can plan around. Spend the next 30 days working with your real estate agent to develop a wish list of haves and have-to-haves within a property that you'd be looking to buy. Be selective in your search and don't compromise. Interest rates and home prices are likely to fall over the next 30 to 60 days, but at least one of those two is a near certainty. It would be best if you got really serious about that home search by mid-December to early January, because I anticipate seeing another soft inflation report between now and then. If that happens, the forecast for interest rates is going to fall quickly and buyers' interest will return to the market rapidly. Should that happen, you might find yourself back in familiar territory of bidding wars and conditionless offers by the time we reach spring 2023. No guarantees, but this is how you'd protect against that. In the first half of this video, I've given my expectations for mortgage rates and home prices in the near term. In the second half, I'll be focusing on breaking down the charts and explaining why I believe that interest rates will decrease over the next 12 months due to rapidly falling inflation. It would be great to have you stick around for that as well. If you enjoyed the video to this point, please hit that like and subscribe so you don't miss these videos again in the future. Whether you agree or disagree with my expectations, get into the comment section and let me know your own thoughts. In this part of the video, we're going to be exploring where inflation currently stands today, both on a headline figure and on a core figure, which strips out some of the most volatile items within the inflation report calculation, more specifically food and energy prices. We're going to be looking at how these numbers reflect first in Canada and also the United States. I want to be abundantly clear about something. I'm well aware that current consumer prices are very high, well above the 40-year trend, and have not seen a precipitous fall from their peaks. That being said, the point of this exercise is to get a better understanding of what leading indicators are showing us. What can we anticipate in the months to come and the quarters to come? That is how we form some decision making around what mortgage products are appropriate and what directionality the real estate market and other asset prices may take in the near to mid term. Let's slowly jump into it, starting on the Canadian side first. Canada's annual inflation rate was 6.9% in October 2022. That's on a year-over-year basis. That remained unchanged from the prior month and was in line with market expectations. Most of that growth was due to motor fuel and higher mortgage costs, which was partially offset by slowing down inflation in food prices. Consumer costs rose at a faster pace, specifically transportation, as a result of soaring gasoline prices. This was after OPEC Plus had supported a cut to the production of crude oil. I want to take a quick look at what has happened with oil prices since, just to get a better indication of how oil prices have come down from the month of October to where we sit today. If we look at the price of oil over a 3-month basis, we could see that at the start of October, it spiked from about $79 and change up to a high of about $93. It trended around $85 to $88 for the majority of the month, and then peaked out around $89 near the end of November. Today, it sits at about $78.81, and most of the month of November has seen a downtrend in the price of November, so we should see some relief both in producer prices as it relates to the cost of crude and as an input cost, and also in consumer prices. When in December we eventually get the reading for the month of November, we should see that drawdown in oil prices reflected. We just viewed headline inflation, which is the cost that consumers pay for complete retail goods and services. Next, we want to have a look at Canada's producer prices in order to understand what we can anticipate in future consumer inflation reports that'll be due out in December for the month of November. So for that, we're going to look at Canada's producer prices for the month of October. The producer price index measures the average change in price of goods and services sold by manufacturers and producers in the wholesale market, so not to retail. Looking at what happened in the month of October, we could see that for the first time in 5 months since June, we saw a rebound in producer prices. So costs for producers are rising, and we want to look at why. For that, we're going to look at Canada's raw material prices index, which went up 1.3% on a month-over-month basis in October after having fallen 3.1% in September. That was mostly due to higher prices for crude energy products. The price of oil went up by 5.1% in the month amid expectations of lower crude production. Recently, we saw a rumor that came out that Saudi Arabia was going to increase production. About an hour later, that turned out to be false. There was also an increase in the price for canola oil, but prices fell for logs, pulpwood, natural rubber, and other forestry products by 9.5%. On a year-over-year basis, prices of raw materials increased by 9%. If we look at the 5-year trend line for producer prices, we could see that we had peaked out earlier this year, roughly in May, June, and since we've trended down. It's almost certain we're not going to return to the 5-year trend line of roughly 100, but we do hope that prices will still fall lower as consumer demand continues to wane as a result of rising interest rates having a deeper effect in the economy. We know that producer prices are being mostly overwhelmingly affected by the price of crude oil. That feeds into so many other producer prices that ultimately that's going to be the greatest barometer for what we could expect in raw material costs, producer prices, and eventually in consumer inflation. So that's the metric that we should be following most closely. I'm no expert on crude oil, but there are some things that I do know. One simple truth is that crude oil can be found in just about everything your mind can conceive of. It's an input cost for pretty much all the goods and services that are weighted in our consumer price index basket. That's why I call it the barometer for what may ultimately happen with any thesis that we have about interest rates, and as a result, home prices. Frankly, crude oil sits sort of at the top of the graph chart, if you will. If crude oil prices begin to rise well beyond anything that's being forecasted as a result of geopolitics, we could then see that impact raw material prices. As a result, that would impact producer prices. Consequently, that would then impact consumer prices that are paid at the retail level. If consumer prices are rising, the central banks will increase lending rates on mortgages, and as a result, the home prices will continue to trend down. The consequence of rising crude prices cannot be overstated. That's why it's the barometer. We've discussed what's happened with crude oil. We want to have a look at some other commodity costs to understand how these inputs may affect what ultimately gets priced into the consumer price index basket over the months to come. We talked about crude oil. Let's have a peek at natural gas. With positive developments taking place with the war in Ukraine, we saw natural gas top out around $9.36 over the late summer. It trended all the way down to about $5 in late October, but it's since rebounded to about $6.90. Obviously, with a certain degree of uncertainty around what happens next in that conflict, prices are still elevated, but there's certainly room for them to come down if any positive developments come out in the short term. Looking at some other commodity costs, we're going to have a peek at metals first. Copper is the one that tends to be the greatest leading indicator of what's happening in the economy. We do see that prices for copper are towards the very low end of the 52-week range. Not quite at the 52-week low of $3.13, but at $3.61, we're certainly in great territory. That's largely off the back that China remains largely locked down. Industrial production is still very low, and thus copper prices remain quite low. Certainly they have a lot more room to fall, assuming that the economy continues to slow down globally. It certainly looks that way. Next, let's have a quick peek at agriculture prices. Food is one of the driving categories of the CPI basket in Canada, along with shelter and transportation. Raw materials obviously include some of the inputs that go into corn, wheat, and the production of these agricultural products. But we do see that both corn, soybeans, and wheat are all trending towards their 52-week lows. Some are near their average, but particularly wheat, again, tied to what's happening in Ukraine and Russia. With some positive developments, we've seen those prices trend down over time. And with growth demand waning across most of the world right now, those prices are trending down. Barring any extension or acceleration of the war or ongoing drought conditions, we should see those prices continue to trend down. Here's hoping. And in the months ahead, we should see that reflected in producer prices and eventually the consumer price index basket. As I was editing this video, we did see a pretty sharp change in commodity prices from Tuesday to Wednesday, November 23rd. So I wanted to provide a quick update and context. Gasoline prices dropped meaningfully on the day as a result of China extending COVID lockdowns in a lot of cities, including manufacturing hubs in the country. We now have gasoline prices down about 18% since August 1st. Natural gas prices also spiked today. No particular reason that I could find, but likely related to the ongoing war in Ukraine. So natural gas prices are down about 12%. These change in prices are reflected since August 1st of this year. I'm using that as a date because we did see producer prices and consumer price indexes plateau around May and June of this year. So I do think that's sort of a catalyst point to see what's happened with commodity prices since that time. Shipping prices continue to fall precipitously, now down about 52% on a global freight container cost. But from China to the United States, shipping costs are actually down 75 to 85%, depending on the east or west port. On Wednesday, November 23rd, we received 3 data points out of the United States, all of which are a catalyst towards a slowing economy. First, we could see that building permits on a month-over-month basis for the month of October were finally revised to a negative 3.3 reading. It was 1.4% in the prior month. It was forecasted at minus 2.4. So we're seeing a greater slowdown in housing in general over the last few months. This is part of a much longer downtrend in housing activity. But of even greater importance to the trajectory of interest rates in the United States and consequently in Canada as well, we look at U.S. initial jobless claims for the week of November 19th. We could see that the number came in at 240,000 compared to a forecast of 228,000. That was largely off the back of a spike in unemployment in the technology sector. That may be partially due to a holiday closure over that time period, but we could see that the 4-week moving average also rose above expectation. So we do see, although very, very slowly, a slightly softening labor market, but I do anticipate that over the next couple of weeks, we're going to see jobless claims jump in a material way as we did this week as a result of layoffs in the tech industry, but likely other industries as well. The last data point, and possibly of the greatest significance, is the U.S. S&P Global Composite PMI. The S&P Global Composite dropped to 46.3 in November from 48.2 in the previous month, signaling the sharpest pace of contraction in the private sector since August and among the quickest since 2009. New orders fell the most since the initial pandemic wave in May 2020 as the impact of high inflation and rising borrowing costs weighed on demand, while the pace of job creation was marginal. On the price front, input cost inflation softened for the 6th month, running to the lowest level since December 2020. It remained high overall, but selling price inflation eased to an over 2-year low. I want to take a look at the strength of the consumer. Sadly, I have to look at US data because Canadian data made available from Statistics Canada has a ridiculous lag time to it, typically about 6 months. So, looking at two elements of consumer strength. One is the rate of personal savings, and the second is US credit card and household debt. Looking at the personal savings rate, we could see that there was a very meaningful spike as the economy went into lockdowns in 2020 during the height of the pandemic. It's since trended down with a couple spikes along the way due to stimulus checks that went out. Today, the savings rate sits at a meager 3.1%, dramatically lower than the 10-year trend. In addition to saving less money, U.S. consumers have accumulated credit card debt at an astounding pace after stimulus checks worked their way through the system. Looking at a 5-year trend line, we could see that back in Q4 2019, credit card debt peaked. Since then, it began trending down dramatically as interest rates were cut to near zero and stimulus checks found their way into the economy. That bottomed out around Q1 of 2021. Since then, credit has reaccumulated at an astounding pace as a result of several factors. One, interest rates have been climbing at the fastest pace in 40 years. In addition, consumers are also dealing with inflation that's the highest that it's been, I believe, over the same 40-year period. They're getting double whammied, and there are no stimulus checks to save them now. On November 23rd, we received the release of the Fed meeting minutes, which were originally taken back on November 1st and 2nd. This was prior to the U.S. Central Bank's release of the October Consumer Price Inflation Report, which ended up being a very soft inflation reading relative to what we'd seen in the months prior. So just keep that in mind as we go through these details. Officials support slowing the pace of interest rate hikes soon. The minutes noted that a substantial majority of participants judged that a slowing in the pace of increase would likely soon be appropriate. Right now, if we were to look over at the Fed probability tracker, the highest probability is for a 50 basis point move in the month of December after 4 consecutive 75 basis point moves as the central bank tries to tame stubbornly high inflation. Committee members expressed concern about risks to the financial system if the current aggressive pace of tightening is maintained. The committee cited uncertain lags and magnitudes associated with the effects of monetary policy actions on economic activity and inflation. This is something I've discussed in great detail on this channel, the lagging effect of all the monetary policies that have changed over the last 8 months. Policymakers noted that falling commodity prices and the unsnarling of supply chain bottlenecks should contribute to lower inflation in the medium term. I'll remind you, this set of meeting minutes was put together prior to the release of the October Consumer Price inflation report, which was weaker than expected. The point of this video isn't to convince you one way or the other about going out and making a purchase of a property or the decision around which type of mortgage product to take, be it a variable or a fixed rate. The intent and purpose is to help you become better informed about the realities of the economy as it looks today by aggregating a lot of different data points and helping to form an opinion. I strongly advise that you do your own due diligence, speak to parties that you respect, that you feel have a great understanding of the macroeconomy and around mortgage products before making a decision about what's appropriate for you. That being said, I can't overstate the importance of the strategy of right now securing a 120-day pre-approval for both a fixed and a variable rate mortgage and seeing how things play out over this window of time. We're at, if not a turning point, then at least a very volatile environment where bond yields certainly have the potential to come down in a meaningful way as consumer spending slows and different parts of the economy begin to fracture. We're seeing some softening on the employment front and meeting a lot of the criteria that US Fed and the Bank of Canada officials have said is required to see a tapering in interest rate hikes and potentially a cut long down the road. That being said, thanks so much for tuning in, and I look forward to seeing you in the next one.